Hello guys, good day. Welcome to another video lecture in ACC 311 Income Taxation. This video is about foreign tax credit. This video lecture guys is just a short lecture pertaining about foreign tax credit. Okay, so when we talk about tax credit, it means the amount allowed as deductions from the tax due in the form of creditable withholding taxes and foreign income tax paid or accrued. In simple terms, when we talk about tax credit, it is the amount to be deducted in the computed tax due of the taxpayer, whether it is an individual or a corporate taxpayer, in determining its eventual tax payable. Okay? As used in the tax code, it refers to the taxpayer's right to deduct from the income tax due the amount he or it has paid to a foreign country subject to limitations. So, if ever an individual or a corporation has paid an income tax abroad, this tax paid in abroad can be claimed as a tax credit here in the Philippines. It is actually allowed to lessen the harshness of taxation where the same income is subject to both foreign tax and Philippine income tax. Okay? So, again, tax credit is the items that is deducted to the computed tax due. And in particular, one of the tax credit that a taxpayer could claim is your foreign tax credit. Foreign tax credit are those foreign taxes paid abroad but are at the same time such income are also taxed here in the Philippines. So to lessen the harshness of the taxation, whatever they have paid abroad can also be deducted here in the Philippines as tax credit but with a limitation. So as to the limitation, we will be discussing that in the succeeding slides. Okay, so here are the taxpayers who are entitled to deduct foreign tax credit. We have four. We have your resident citizen, domestic corporations, members of a general professional partnership, and beneficiaries of estate and trusts. So these are the four taxpayers that could eventually deduct whatever they have paid na mga foreign income taxes abroad here in the Philippines. On the other hand, we also have here the list of taxpayers who are not entitled to tax credit. Number one, we have your non-resident citizens. Two, your alien individuals regardless ng resident ba or non-resident. Because again guys, when these are our taxpayers, when our taxpayers are alien individuals and non-resident citizens, they are only taxable on their income within the Philippines. So therefore, whatever income they have derived outside the Philippines will not be taxed here in the Philippines. So that is why there is no double taxation on their earnings. Unlike with the previous one, like your resident citizen and domestic corporations, take note that these type of corporations are taxable on their income within the Philippines and income wherever situated. So therefore, there are instances really that they are paying taxes on their income worldwide here in the Philippines, and they will also be paying taxes on their income derived for a specific country because they are liable to pay income tax for that particular country as a resident or as a non-resident citizen of that particular country. So therefore, again, the objective of this tax credit is to reduce the amount or the total taxes that they are paying both outside the Philippines and within the Philippines, they could claim whatever tax payments they have made outside the Philippines as a tax credit diri sa Philippines. Okay? So, again guys, we have um, two ways, no? We have two ways on how are we going to treat your foreign tax payments. It's either we could use it as a deduction, or second, we could use it as a tax credit. So later on, we will identify how are we going to differentiate these types of treatments with regards to your foreign tax credits. Okay, number one, for example, it only includes foreign tax payment for a single country. A domestic corporation reported the following result of operation. So it has a taxable income from the Philippines of 1.8 million, taxable income from Japan of 1.2 million, and quarterly estimated tax paid in the Philippines for 200,000, and income tax paid in Japan for 300,000 also. Okay, in this case, our taxpayer is a domestic corporation, so therefore, on its capacity as a domestic corporation, it will be taxable on its income worldwide. Okay, it is taxable on its income from the Philippines and on its income from Japan. Okay, and at the same time, since it has operations sa Japan, guys, so therefore, ang kanyang status in Japan is a resident corporation. Okay, or a foreign corporation. So since it is a foreign corporation in Japan, it is also liable to pay tax on its income sa Japan in the Japan government. Okay? So that is why it has paid taxes in Japan for 300,000 for its operations sa Japan also. So again, the objective here, guys, is to compute for the tax credit that can be allowed nga i-claim ni domestic corporation from the foreign tax payment it made sa Japan for 300,000. Okay? So as mentioned earlier, we have two ways. So one is your deduction method or deduction approach. So under deduction approach, okay, under deduction approach, your income tax paid abroad will be treated as a deduction towards your income, thus making your total taxable income be reduced. Okay? From your taxable income from the Philippines na 1.8 million plus your taxable income from Japan na 1.2 million, giving you a total taxable income worldwide of 3 million. But since you have used the deduction approach, the 300,000 tax payment in Japan will be treated as a deduction. So that is why your taxable income worldwide this time will no longer be 3 million but rather be 2.7 million times 30%. So therefore, your corporate tax due in this case will be 810,000. Okay? 810,000 less the amount paid in the previous quarters in the Philippines amounting to 200,000. Therefore, in this particular tax payment, there will be a tax still payable amounting to 610,000. Okay? So under this deduction approach, the foreign taxes paid are deducted but will not be claimed as tax credit. So again, under deduction approach, whatever income tax paid abroad will be treated as an expenses, thus reducing your total taxable income. Okay, so let's proceed with another illustration. So this illustration also considers the tax credit approach. So in this case, it will be considered as a tax credit already. So tax credit will be amount to be deducted from the tax due itself. Okay, so the first objective here is to, or the first procedure is to compute for the total tax due or the tax liability of the corporation. So again nga, since it is a domestic corporation, so therefore it is liable on its income from Philippines and in Japan. So we have a taxable income worldwide of 3 million, multiply it by our corporate tax rate na 30%, thus giving us a corporate world tax due of 900,000. Okay? 900,000. Now this time, let us compute for the allowed foreign tax credit that can be claimed by the corporation or the taxpayer. So to compute for the limit, we have here the formula: foreign income tax over worldwide income. Oh, sorry, it is not foreign income tax but foreign income. Okay, foreign income over worldwide income times Philippine corporate income tax. So in this case, guys, our foreign income is 1.2 million and our worldwide income is 3 million. So we have 1.2 over 3 million, multiply it by our total tax due or worldwide income tax due of 900,000, thus giving us 360,000. Okay. Your 360, guys, your 360,000 will now be compared to your actual foreign tax paid. Okay? So 300 360 versus the actual payment of 300,000, whichever is lower will be the amount applicable as foreign tax credit. So in this case, needless to say, the amount to be credited will be 300,000. Okay? 300,000 plus the 200,000 na tax credit which was paid in the previous quarters. So therefore, making your total tax credit totaling to 500,000. Okay? So you will now have a total tax credit of 500,000. So it will be again be reduced sa inyong corporate world income tax due of 900,000, thus making your income tax payable na lang of 400,000. Okay? 400,000 na lang ang ato ang liability, income tax payable. Okay. So that is the procedures when the corporation is only operating for a single country. So what if this time there is operation in multiple countries? For example, a domestic corporation with the following data in its Philippine and foreign operations. Like it has taxable income in the Philippines of 1.8 million, taxable income in Japan of 1.2 million, and at the same time, it has a taxable income in Taiwan of 1 million also. And it also made a quarterly income tax payment in the Philippines of 300,000 and made a tax payment in foreign countries for Japan 400,000 and in Taiwan for 200,000. So in this case, guys, we will have two bases in computing for our foreign tax credits here. Okay, we will have two bases. Number one is we will be computing the limit per country. Okay? We will be computing the limit per country. So again, same formula. We have foreign country income over worldwide income. So in that case, we have 1.8 plus 1.2, so that is 3 million plus 1 million. So we have 4 million na worldwide income. So your worldwide income, that will be your denominator, and then your numerator per country will be the amount of income in each country. Okay? So to compare, we have actual amount paid in Japan for 400,000, and then country limit only includes the income from Japan of 1.2 million over the worldwide income of 4 million. Multiply it by you multiply it by 1.2 million. Okay, what is that 1.2 million? 1.2 million, guys, is your worldwide income tax due. So that is coming from 4 million times 30%. So that is, I think, 1.2 million if I'm not mistaken. But that 1.2 million is really the total amount, no, of the income tax due worldwide. So to compute for the country limit, you'll have 1.2 million over 4 million times 1.2 million. So in this case, Japan will have 360,000. So you compare 400 and 360, whichever is lower, that will be applied. So in this case, for Japan, there is 360,000. Okay, we have 360,000. Now, same procedure will be followed in accounting para kay Taiwan. Okay, para kay Taiwan, you have their actual amount paid of 200,000. Okay, and then compute for the country limit. Country limit will have 1 million. Okay, your 1 million is coming from its income from Taiwan of 1 million also. 1 million over 4 million, which is the total worldwide income, times 1.2 million, which is still your total worldwide income tax due. So 1 over 4 times 1.2 million, so it will have a country limit of 300,000. Compare it with the actual amount of income tax paid in Taiwan, so we'll have 200 versus 300,000. So you'll have a lower amount, no? So we'll have 200,000. So after such, guys, you will be aggregating the total allowable tax credit per country. So you'll have 360 for Japan, and then 200,000 for Taiwan. So we'll have 560,000. Okay? So that will be our first amount, no, to be compared later on. So that will be our first option. But we will still have another option. This time, computing naman on the point of view of aggregate amount, meaning it will not be computed per country, but it will be computed on the aggregate foreign income. Okay? So foreign income over worldwide income. So our foreign income here would constitute the total income from Japan and total income from Taiwan. So from Japan, we'll have 1.2, and from Taiwan, we have 1 million. So we have 2.2 million worldwide income. 2.2 million na foreign income over 4 million na worldwide income. Still, this is to be this is to be multiplied by 1.2 million, which is our tax due, okay, to compute for the world tax credit. So in this case, guys, we have 2.2 million divide 4 million times 1.2 million. So we will have um, world tax credit of 600,000. So in this case, we will be comparing 600,000 versus the previous option that we had na na-compute nato, which is the aggregate credit per country na 560,000. So compare 560 versus 600. So the amount of tax credit that can be claimed will be 560,000. Okay? So the amount allowed to be credited will be 560,000, which is lower between um, the tax credit allowed per country and versus your world tax credit. Okay? So if the problem would now would ask us to compute for the total tax payable of this particular corporation. So again, from our 4 million taxable income earlier, multiply it by 30%. Okay? Multiply it by 30%, so you have 1.2 million, if I'm not mistaken. Okay, we have 4 million times 0.30%, so we have 1.2 million minus your quarterly income tax paid, guys, na 300,000, and then also minus the the allowed tax credit na 560,000. So minus 560,000, so therefore the income tax still payable of this particular corporation will be 340,000. Okay? 340,000. Now, before we proceed with the important notes, guys, the problems or the samples that were presented is focused on corporate taxpayer. But take note that foreign tax credits can also be used in terms of individual taxpayers. Okay, so you will just simply follow the rules or the methods in computing or the procedures in computing for the tax due ni resident citizen. So again, you'll have to compute first for the you'll have to compute first for the total tax due of the taxpayer of an individual taxpayer worldwide, no, since it is taxable on its income within the Philippines and outside the Philippines. So the first thing you need to do is compute lang muna the total tax due. So using the table, you can compute that, and then same rule earlier, if ever isa lang ka-country ang iyang gibayaran or multiple countries. So kung isa lang ka-country ang iyang gibayaran, then therefore you will have your foreign taxable income over worldwide taxable income times the total tax due it pays or it has paid in the Philippines, or it has it will be paying in the income tax due sa Philippines. Okay? So same lang na rules kaganina sa corporation. It's just that the tax due will not be multiplied by 30%, no? Kay ang pag-compute man nato sa tax due sa individual taxpayers is using table. Okay? So yun lang ang kalahian, pero as to the computation of the limit, it will still just be the same. Okay? Now, let us proceed with the important notes nga kailangan nato i-observe, guys. We have here, can claim tax credit or deduction for foreign taxes paid. Okay? It is consistent with the matching rule. Only taxpayers taxable on world income, such as domestic corporations, resident citizens, can claim deduction or tax credit for foreign income taxes paid. So it only reiterates that only those taxpayers who are liable to pay income tax due on their income worldwide or wherever situated are allowed to claim income tax credit or foreign tax credit. Okay? It was mention man pod kaganina sa to ang previous na mga slides na non-resident citizens and non-resident non-resident or foreign corporations are not allowed to deduct foreign tax credits because obviously they are not taxable on their income outside diri sa Pilipinas. Okay? And then lastly, tax treatment or refunds or credit of taxes. So the refund or credit of deductible taxes must be reverted back to gross income to extent of their tax benefit. Incidentally, the refund of non-deductible taxes is exempt from income taxes. So if ever there is a refund daw or tax credit, okay, what will be the treatment? Whether it is ano ba includable sa atuang gross income or not. So as discussed in our gross income, there are items of taxes na when it is refunded to the taxpayer can be included or be deductible, be taxable. But in this case, we are talking about income taxes, and it is one of the six types of taxes, guys, that when it was refunded or it is credited to the taxpayer, it will not be, it will not be taxable, and it will no longer be added sa iyang gross income. So therefore, it is exempt from income tax. Okay? So I think that's the end of our lecture for foreign income tax credit. Okay? So if you have any more questions or clarifications, you may prepare it and address it on our virtual class, or you could comment down below for an immediate response. Okay? Thank you very much for watching my video, and see you on our next video lecture. Thank you and God bless.